Hi, everybody. Welcome to the Dean's Institute. Now, uh, just indicate that if you're able to hear me so that we can start the program. So, do we have. Okay, right. So, do we have everybody on YouTube now? So, shall we start? Okay, right. So, let's get started. So, let the others join us. All right. So, first of all, I hope you're able to see this is a typical question that you will be getting in your examination. Okay, I have deliberately paused it for you to have a look, and then I can go one by one trying to explain each part of it. Okay, typically you'll get a balance sheet, you'll get some adjustments given over here, and they will ask you to prepare revaluation account, partners capital account, and the balance sheet. So let's get started. Right. So do we have everybody on YouTube now? So shall we start? Okay. Right. So let's get started. So let the others join us. All right. So first of all, I hope you're able to see this is a typical question that you will be getting in your examination. Okay. I've deliberately paused it for you to have a look, and then I can go one by one trying to explain each part of it. Okay, typically you'll get a balance sheet, you'll get some adjustments given over here, and they will ask you to prepare revaluation account, partners capital account, and the balance sheet. So let's get started. Okay, as you can see, there are three partners: Digvijay, Brijesh, and Parikiram. Right. So do we have everybody on YouTube now? So shall we start? Okay. They are sharing profit in the ratio 2 is to 2 is to 1, which means. All right. So first of all, I hope you're able to see this is a typical. So British will get the total number of shares are 5, 2 plus 2 plus 1, which is 5. Digvijay, the old profit sharing ratio, this is. Digvijay gets 2 out of 5 portions, Brijesh gets 2 out of 5, and Prakaram gets 1 out of 5. Okay? And as I have highlighted, what we need to prepare is the revaluation account, the partner's capital account, and the balance sheet. So let's just wait for a minute because there's a sound coming from back, so you will not be able to follow. So just give me a minute, we'll resume. اللهم رب هذه الطامة والصلاة القامة آتي محمدا الفضيلة والدرجة الرفيعة الذي وتقنا شفاعته يوم القيامة إنك لا تخلف الميعاد. Right. Thank you for the patience. So let's get started. Now, first of all, let's understand what is creation of a revaluation account. If you ask me in simple terms, it is an activity to either reduce or increase the value of an asset or a liability, or if any expenses have to be written off. So, reducing the value of an asset, or you could increase the value of an asset. So, the way we decrease our value of an asset is by depreciation, and increase the value of it is by appreciation. And you may also increase or decrease the value of a liability. That means uh, this loan will be written off or will be paid by one of the partners. So like that, that that is what is actually done in a revaluation account. So you either reduce or increase the asset of a asset or a liability, or if you have some expenses which you want to write it off, which the partners agreed to write it off, you, they go ahead and do that. Right. Now, what is the purpose of creating a revaluation account? So let's understand that. Since one of the partners is either joining a company or retiring a company, or one of the partners has died, or the company has dissolved. So this is 4 chapters we are learning. Revaluation account, the procedure is almost the same in all the 4 chapters. Principally, they are all alike, except for in retirement of a partner, you get gain ratio. In admission of a partner, there is sacrifice ratio. So, in if a death of a partner also, there is gain ratio there. And when a company is dissolving, because all the partners, the company itself is dissolving, so all the partners cease to remain partners. So I hope the uh, streaming is going well, because on YouTube I'm not able to see that screen. So if you can just text me in the chat area if it is going well, because what I'm explaining, can you see on the screen? Streaming is going well. Okay, right. I think it is. Yeah. Thank you. Right. So it is to distribute the either the profits or the losses between the partners. If during the revaluation, if we end up with a profit, the profit is shared based on the old profit sharing ratio, as I discussed in the previous slide. And if there is losses also, it has to be borne by the old partners at the uh, old profit sharing ratio. Okay, so right. Now let's move on. Let's typically see, will work. Okay. Now in this case, as you can see, uh, the first item that is given is goodwill. Uh, Goodwill is a, it's neither increasing or decreasing the value of an asset. So goodwill is an item which will be discontinued, and whatever goodwill the company has made, in this case now I'm specifically talking about retirement of a partner. So in this situation, the goodwill, whatever the company has earned, basically what is a goodwill? A goodwill is a name the company has earned, the reputation for which there's some monetary value that is assigned. There is some monetary value assigned to the uh, organization because it's functional, it is making profits. So for that there is some value that is attached to it. Now they have arrived at a value of 70,000 rupees, and it will be distributed in the old profit sharing ratio, which the old partners have to, the remaining partners have to give to the exiting partner, the partner who is retiring. So therefore, goodwill, we will not take it in revaluation. We will take it in partners capital account, and it will reflect in the partners capital account. Okay, so that's why the first statement in the adjustments you just need to ignore for the revaluation account. So the second thing is, one second. Okay, let me play this. Yeah. So yeah, the goodwill. I mentioned it over there that goodwill is not needed because it's a partner's capital account element. Okay. Second item given is bad debts. Typically, I am highlighting these things. This is how uh, you should actually do it in examination. Preferably you can use a pencil to do that, because you may not be allowed to use a marker or highlighter. So you can typically use a pencil. Later on you can use an eraser and rub it off. So highlight these keywords, so your focus will be on that. So bad debts, it's 2000 rupees and it has to be written off. So that's the first entry which is there, which will go into revaluation account. And then the second entry is the patents. Yeah, the patents uh, is useless. So that also we have to write it off. So now let's see how do we do. So in a revaluation account, you have, this is the typical uh, template. You have the debit side, particulars amount, and credit side, particulars amount. So because it is increasing, I've used a green color. It is easy. It is easy for you to remember. It stands out. And red is where the value is going down, and green the value is going up. So deliberately I've used these colors to differentiate that on the left you have the debit side and on the right you have the credit side. Okay. So now, because the bad debts and the patents, the value is reducing. So therefore we have to write it on the left side, which is the debit side. So as you can see, bad debts 2000 rupees. It's already visible there. Now the second entry is the patents, which is 9000 rupees. So as far as increase in the value in this sum, there is no such adjustments given in the adjustment section. So typically there's going to be no additions. So by now you would have figured it out. Yeah. So 11,000 is the total of 9,000 and 2,000 put together. And as you can see on the right hand side, see, in accounts, basically you get two types of statements. One statement is where you need a balancing figure, and there are some statements like trial balance and balance sheet, and so these, they have to tally on their own. If they don't tally on their own, realization account, which will come in dissolution of a partner. So these three statements is where the total should tally on their own. If they do not tally, that means something is not right. Okay, you have to go back and check, some of the entries are incorrect. But as far as revaluation is concerned, partners capital is concerned, you will have one side greater than the other side. So in this case we have 11,000 on the debit side and nothing on the credit side. So which means it is a loss of 11,000 rupees. Now in order to balance both these sides, we have to add 11,000 rupees on the credit side. So therefore I've written it has to be distributed among the partners on the old profit sharing ratio. So you will take Digvijay will get 2 divided by 5 into 11,000. That's, I think so, it's 3,600. And then so I'm sorry, it's 4,400, and Bridges will get 4,000. He has to pay off 4,400 and he has to pay. Typically this is how you're going to do in your examination. You're going to draw like this, a table like this, a revaluation account, and over here on the left hand side on top you have to write dr, and on the right hand side you have to write cr. So the bad debts, you have to write two bad debts, two patents, and on the other side you should write by loss transferred to partners capital account. So this is as simple as that, revaluation account. I hope you've understood so far. Yeah. So now let's understand what is partners capital account. What is this creation of it. It's an activity where we minus. Okay. In partners capital account, uh, on the debit side, we have to include the losses or the written off amounts. We have to write on the debit side. Any goodwill which is given away by the remaining partners to the leaving partner, that also will be written on the debit side of the partners who are staying in the company, and you will credit it to the person who will be getting it. So okay, you add all the old capitals first, then distribute the general reserve based on the old profit sharing ratio, and any gains you would have done in sometimes in the previous year's balance sheet. You may have a profit that also you can share it. You have to share it on the credit side based on the old profit sharing ratio. And even if you've made any profit in the partners capital in the revaluation account, that also you will distribute it. Similarly, if there was any loss in the previous year's balance sheet, that also has to be debited into their respective accounts. And the goodwill to a partner who is leaving, you will give. In admission of a partner, you do the reverse. The partner who's joining, his account will get debited, and the partner who are already the old partners, their accounts will get credited. So that's how it will work. Okay. Right. So again, I've used the same procedure. I have told you why, when it is done, and why is it done. Again, this is also the matter where if any partner is getting added or getting admitted, or has has retired or is retiring, or one of the partner has died, or the company is closing down. So the same situation. Now the main purpose behind creating a partner's capital account is to arrive at the new capitals for the old partners. Okay. And uh, how much is the capital which the leaving partner will need to get. So we need to understand how much the old partners have to pay back to the leaving partner in this case. Okay. So that's the reason a partner's capital account is created. Okay. First thing is we come back to the old balance sheet, and for each partner we pick up their capitals from here. Like in this case, Digvijay's capital is 82,000, Bridges' capital is 60,000, and Parakaram's capital is 75,500. We take we take these figures from here and we stick them on the credit side of the partner's capital account. Okay, now we are distributing the goodwill as per the old profit sharing ratio, which is 2 by 5 for Digvijay, and the goodwill was valued at 70,000. So 2 divided by into 70,000 is 28,000. So Digvijay will get 28,000 from the goodwill amount. Bridges is entitled for again 28,000 because the ratio is same. I've got some hiccups and sorry about that. And Parikram's old sharing profit sharing ratio is 1 by 5, which is 14,000. All right. So this is how it will be distributed. Now we also need to find out what is the new profit sharing ratio for the remaining partners. Digvijay will get two-third and they have to pay 28,000 to Bridges. So using the new profit sharing ratio, Digvijay has to give away 16,667 and Parikram has to give away 1 by 3 of 28,000, that is 9,333, because these people are staying in the company. So goodwill is generally not taken by partners. It is a calculated figure only in three circumstances. Number one is when a new partner is coming. At that time, the new partner has to pay goodwill to the old partners. That's one situation one. Situation two is like in this case, where one partner is leaving, so the the remaining partners should pay a goodwill to the leaving partner because he will no longer be enjoying the benefits or the profits of the organization. So they're giving him one amount, a lump sum amount, for being a part of the business and contributing. So based on that, Digvijay and Parakram are continuing in the as partners in the business, and it's only Brijesh who's leaving. So for that reason, Digvijay and Parakram have to pay to Brijesh. So Brijesh's share of the goodwill is 28,000. So Digvijay is using his new profit sharing ratio to give out of that 28,000. He has to part away 16,667 and Parakram has to give 9,333. Followed? Okay, let's move on. Now, bad debts. Okay, this, yeah. Well, I've just shown you all the calculations first and then I will show you. Then it's merely just putting these values in the sheet. So this is like you have a working column, right, where you need to do this workings. So you do at the side, it's always better to put a line and do these workings, and then in your sum you can go and transfer these values. You can even do it in between also, that's also fine, or you can write it on the right hand side. You can draw a line and use maybe one third of the page to do these calculations. Now the bad debts, because it was done at the old profit sharing ratio, that is 2 by 5 into 2000, which is 800, bridges 2000. This we already
showed it in partners capital account, but we will also be using it in we did it in revaluation account, but we will also be using it in partners capital account. Okay, so and the same thing we are doing for the patents. So the patents also 2 by 5 into 9,000, 2 by 5 of 9,000, that is 3,600, 3,600, and this is 1 by 5, which is 1,800. Okay, right. We'll come back to this part a little later. I just want to skip this part. Okay, yeah. Let's see here. 82,000, 60,000, and 75,000. This we have taken it from here. Yeah, 82,000, 60,000, and 75,500. So that's what we have mentioned it over here, which is 82,000, 60,000, and 75,500. Then the general reserve. The general reserve, let me see where the calculation is done. Okay, yeah. So the general reserve 7,400 out of this amount. One second. Yeah, there is general reserve 18,500. In 18,500, you take 2 by 5 into 18,500 for Digvijay, 2 by 5 into 18,500 for British, and for Parakram, you'll take 1 by 5 into 18,500 because that's the whole profit sharing ratio. So, based on that, you'll arrive at this figure. Yeah, so and this we already saw that uh, Parakram, Brijesh is the partner leaving, so he is entitled for 28,000. And that 28,000, Digvijay and Prakash have to, Prakaram have to give. I'm sorry, I've written as Prakash, it's Prakaram. So they have to give. So that's why you have to write it on the debit side. Goodwill for Digvijay, it is 18,667, and Parakaram as 9,333. Bad debts, I just showed you the calculation 800, 800, and 400. 400. Okay. And similarly, patents, Digvijay has to give away 3,600. These are the loss they made, and 1,800 for Parakram. Because the profit sharing ratio is same for Digvijay and Brijesh, so these values are also same. Okay. So now we are doing the totals. Now 82,000 plus 7,400 makes it 89,400, and this is 60,000, 7,400 plus 28,000, which I have done over here, I think so. uh, yeah, so 82,000 plus 7,400 is 89,400. And for Brijesh, it is, there are three elements: 60,000, 7,400 plus the 28,000, which will come in a minute. Yeah, 28,000. So as you can see, Brijesh is the only one who's getting this goodwill amount. So Parakram's amount is 75,500 plus 3,700, making it 79,200. Okay. So now debit side of it, coming to the debit side of it, Digvijay. 18,667 plus 800 plus 3,600, which, okay, because the greater side, yeah, it is 89,400, right? So 18,667 plus 800 plus 3,600. So everything should work out to 89,000. So 89,400 minus the values will give you 66,333. Okay. Similarly, over here, 60,000, 95,400 minus these two values. This is the new capital of Brijesh. And for Prakaram, it's 79,200 minus these three values, 9,333 plus 400 plus 1,800, which works out to 67,667. These are the new capitals which will, so from the old balance sheet, from the old balance sheet, you need to bring these values, the balance sheet, balance brought down, the capitals, last year's capital, 82,000, 60,000, and 75,500. Take the general reserve from the balance sheet, distribute it based on the old profit share ratio. In this case, it was 2 by 5, 2 by 5, and 1 by 5. So if you take the goodwill and general reserve and distribute, you get this. As far as goodwill is concerned, 70,000 was it valued. So Digvijay was entitled for 28,000, and Brijesh was entitled for 28,000, and Prakaram was for 14,000. Now, since Brijesh is the one leaving, so Digvijay and Prakaram will give this amount to Brijesh. So, therefore, we've credited only Brijesh's account with 28,000. So, if we total this up, you get these values: 89,400, 95,400, and 79,200. And on this side, goodwill, because Digvijay and Prakash have to pay to Brijesh, that's why we have debited their accounts. And the bad debts, it was 2,000 rupees. So 2 by 5 into 2,000 is 800, 800, and 400. And patents also, it was 9,000 rupees. So 2 by 5 into 9,000 is, which is 3,600. 2 by 5 by 9,000 is 3,600, and 1 by 5 is 1,800. So this total minus this total, you come with the balancing figure, which is 66,333 in case of Digvijay, and 91,000 in case of Brijesh, and 67,667 for Prakaram. So that's how simple a partner's capital account is. So this is how typically you will write it in your exam. Okay, you have to particulars, partner A, partner B, partner C, particulars, partner A, partner B, partner C. So here you will write to, and this side you will write by, and here you will write DR and CR. You write partner's capital account. So now let's look at the last part, which is the balance sheet. What is the creation of a balance sheet? It is an activity to either reduce or increase the value of an asset. Okay. So how do you reduce it? If there is any depreciation, or if there is any uh, writing off, like in case of bad debts and other things, you write off certain expense. So there also, the value of your stock also can be revalued, or that's depreciation. And if debtors, if you write it off, so the value of your debtors also comes down. So these are the two ways. And you include uh, the new capital which is generated in the partner's capital account. Okay, and you also find out if there are any new liabilities, because if there are any outstanding expenses, that can be considered as a liability for this year. And you can also get an asset if there is a prepaid expense or an outstanding income, that also will fall under an asset. If there is a outstanding expense or a pre-received income, that will follow as a new liability. So in this chapter you will not get it, but in the other chapters that knowledge is useful for you. Okay, now again, the principle is same, where partners getting joining, retiring, has died, or the company is dissolving. Uh, what are we trying to do in a balance sheet? We're trying to establish what are the latest assets and liabilities of the new organization. So whenever a partner leaves, so it's like a new organization has been created. So by doing all the revaluation, understanding what assets and liabilities will be carried forward, you come up to creating a new organization. So we need to understand as of today what is the current situation of the assets and liabilities of that organization. So now let's see how it's done. So on the left hand side you have liabilities and amount, on the right hand side it's assets and amount. So you first list down the creditors if there are any creditors. So let me take you to the question, so it's easier for you to follow from there. Okay, you see this 49,000, the creditors, exactly, you mentioned this. Reserves we've taken care of in the partners capital account, so this entry will not appear in the balance sheet. Now these capitals we cannot take because we have the new capitals which we will be taking from the partners capital account. The cash, there has been no change, so we'll write it as it is. The debtors, there has been no change, we'll write as it is. Stock also no change, write as it is. Buildings, no appreciation, no depreciation, write as it is. Patents, it has been written off. So we will not write this item. You see how simple it is? It's the easiest one to make among all the three. Balance sheet is the easiest. So now let's see how it is done. See, Bridges loan, because the money has not been paid off to Bridges. This value we got it from here. Let me show you. Yeah, it's here. Let me play this. Can you see? The new capitals are 66,333. For British, he's arrived at his capital, but this money is not being given away. So it will reflect as a loan. So we write it separately. We will not write it as a capital now because he no longer a partner. So we write it as a loan which we need to pay back to British. So 91,000, 67,000, 667, and 66,333. This is what will appear as new balance sheets. Let's see here. Yeah, there you see. Now, now on the right hand side, I said cash will not change. So you write the cash amount directly, copy it from the balance sheet. Debtors, you copy it directly from there, no change. Then stock, no change, right as it is. In this case, yes, I'm sorry. A stock has been revalued. Okay, let's see. Mm, yeah, bad debts. Okay, bad debts amounting to rupees 2,000 to be written off. So 42,000 minus 2,000. So we'll write 40,000. Okay, so my mistake. I'm sorry. So only the item that will go down is the stock, 40,000. And then buildings, no change, 2 lakhs 7,000, I suppose. And then 2,74,000. As you can see, both sides are matching. So this is that simple, guys. So what I suggest you is practice uh, a couple of problems, maybe 3 or 4 problems. In a couple of days' time, we'll take some other two sums, and next time I'm gonna go fast. I'm not gonna what these statements are and why do we make and all those things. I'll just be showing the sum and the working, the sum and the working. So probably in this time we can squeeze in 2 or 3 sums. All right. Thank you so much for joining, and I wish you um, all the luck. And please do subscribe, do share it to your friends, and also do like and leave comments in the comment section. Uh, Thank you so much. Bye for now. And 1 by 5 is 1800. So this total minus this total you come with a balancing figure, which is 66,333 in case of Digvijay, and 91,000 in case of British, and 67,667 for Prakara. So that's the that's how simple a partial capital is. So this is how typically let's look at the last part, which is the balance sheet. What is the creation of a balance sheet? It is an activity to either reduce or increase the value of an asset. Okay. So how do you reduce it? If there is any depreciation, or if there is any uh, writing off, like in case of bad debt and other thing, you write off certain income. So there also the value of your stock also can be revalued, or that's depreciation. And if debtors, if you write it off, the value of your debtors also comes down. So these are the three ways. And you include the new uh, capital which is generated in the partner's capital account. Okay, and you also find out if there are any new liabilities, because if there are any outstanding expenses, that can be considered as a liability for this year. And you can also get an asset if there is a prepaid expense or an outstanding income, that also will fall under an asset. If there is a outstanding expense or a pre-receipt income, that will fall as a new liability. So in this chapter, you will not get it, but in the other chapters, that knowledge is useful. Okay. Again, the principle is same, where partners getting joining, retiring, and dying, or companies. Um, what are we trying to do in a balance sheet? We're trying to establish what are the latest assets and liabilities of the new organization. So whenever a partner leaves, so it's like a new organization has been created. So by doing all the revaluation, understanding what assets and liabilities we can hold, we come up to creating a new organization. So